Hey guys, today I'm going to cover a topic to help our new investors out there make better trades. There are some ways to help automate your trades when you aren't watching your phone or computer if you're at work. If you haven't figured out from the title already, I'm talking about order types. In this video, I'm going to cover 4 types of orders: market, limit, stop, and stop limit orders. Let's break these down so you can start taking advantage of them on your next trade. Let's start with market orders. A market order is the most basic order type you can make. Basically, all a market order means is that you are willing to buy or sell a stock at whatever the going ask price is at the time the order is received by your brokerage. Simple, right? Well, not exactly. You see, while market orders get executed immediately, they actually do take some time. Granted, it's typically less than a second, but what if the stock you are trading is extremely volatile? Or some news just got released and you didn't see it, but everyone else is making that trade based on information that you didn't see. This can lead to buying in on a spike or selling on a dip accidentally. If you are trading in large cap stocks or popular ETFs, you will probably be pretty safe with a market order since the bid and the ask spread is usually pretty tight on those. But if you're trading a small cap or a penny stock or something where the spread between the bid and the ask is too much, you might want to reconsider using a market order. Using a market order in those situations can lead to selling lower than you thought or buying much higher than you thought. It's going to lead to a bad time, is basically what I'm trying to say. Making that kind of mistake as a new trader can be really disappointing and discouraging. Now that you know what can go wrong with a market order, let's look at limit orders. Limit orders have a box where you can fill in a specific price you want to buy or sell a stock. Let's say you want to buy a stock that is currently trading around $60 a share. But you don't want to buy it unless you can get it at $50 a share. Well, all you have to do is set up a limit order and input 50 in that box. If the price drops to $50 or below, your order will start being filled. If the price goes back up above $50, then it will wait for the price to drop back down below before continuing to fill the order. Something to keep in mind with limit orders is that if you place a large order of shares and the price only dips or jumps to the limit you set for a very short period of time, your order may only be partially filled. It's just something to keep in mind when you're dealing with limit orders, that there is the possibility of your order being not filled at all or only partially filled when you make them. Now let's take a look at stop orders. At first glance, a stop order looks exactly like a limit order. With a stop order, you enter the number in that you want the stop to be triggered, just like a limit order. Now here is where it becomes different. With a stop order, once the stop is triggered, the order turns into a market order and is filled at the next available price, no matter what. Think of a stop order as a trigger for a market order to happen. The stop gets hit by the stock going up and down and causes a market order to be placed to either get into or out of a stock immediately. These stops can be very useful for the new investor. Stop orders will always fill since once the stop is triggered, the whole order turns into a market order. The last order type is a stop limit. This is a combination of a stop and a limit order, hence the name. It is seen as the most precise way to trade out of these order types, but there are some drawbacks. Stop limit orders have a number set for the stop and a number set for the limit. Let's discuss an example of buying and selling with this order type to try and make this easier for you all. Let's say you want to buy some stock but want to wait for the next upward breakout in hopes to lock in some quick profit. The stock is trading around $20 a share. You set a stop limit where the stop is at $22 a share and the limit is at $23 a share. In this scenario, once the stock hits the stop at 22, it will trigger a limit order to be placed and your order will start to be filled until the stock starts trading above your limit price at 23. Once the price goes over your limit, the order will stop filling unless the price drops back down just like a normal limit order would work. If you are selling using a stop limit, it's the same thing but in reverse. Let's say the stock we mentioned previously went all the way up to $30 a share, but you aren't sure if it's going to drop back down just as fast. Using another stop limit, you can set your stop at 28 and your limit at 27. This means that if the stock drops down to the stop price at 28, it will trigger the limit order to sell your shares until the price drops below the limit you set at 27, allowing you to cash out between the $27 to $28 per share level. This can help lock in gains you are happy with by triggering a sale where you want instead of watching it dump like Tilray did to me a few months ago, eating up 2/3 of my profits and my will to live. I did mention drawbacks, and the main one with this order type, just like any limit order, is that if there is a gap, which looks like this, and your limit order was in that gapped area, then your order will have no chance of being filled since the price jumped over or under your specified limit. These gaps don't happen all that often, but they definitely can, and it's something to consider when using any of the limit order types. You will tend to see gaps between pre-market trading and market open, so I would recommend being up to see what's happening in pre-market to avoid being gapped first thing at market open. It's happened to me quite a few times and has caused me to not get those sweet gains I was hoping for when I set the order up the night before. I think that's all I have for you guys today. Drop a like and leave a comment if you enjoyed this video. Or if you have any other ideas for future videos, leave a comment down below saying what you want to see. If you haven't subscribed, please subscribe for more videos like this. And we're always going to leave links to the newsletter and our Facebook page in the video description below, so make sure to check both those out. And with that, I'll see you guys in the next video.